The Fibonacci sequence acts as a universal measuring tape for proportion, mapping specific ratios that occur throughout the natural world and the financial markets. This animation shows a typical financial market, where price action often appears as a sequence of random, erratic movements. We can navigate this volatility by identifying measurable waves. Today, you will learn to use these ratios to find calculated entry points during a pullback, avoiding the risk of trying to catch a falling knife. Step 1 is to open your charting platform and locate the Fibonacci retracement tool. This tool acts as a lens. It frames market swings within a structural grid, identifying specific price levels where a trend is likely to react. Before drawing a line, you must verify the market environment. This strategy requires a clear directional move, known as an impulse leg. Avoid using this tool in sideways or choppy markets. Without a clear trend, these mathematical levels lose their structural significance. To map an uptrend, identify the two anchor points, the absolute bottom, or the swing low, and the absolute peak, the swing high. Select the tool, click exactly on that swing low, and drag it upward to the swing high. The tool automatically projects horizontal percentage lines, 23.6, 38.2, 50, and 61.8, across the price action. These lines act as floors. When the market exhausts its push and pulls back, these are the levels where price pauses. Isolating the correct impulse leg is the foundation of the setup. If the anchors are accurate, the grid reveals the chart's underlying structure. Now we wait for the price to fall back into the golden zone, specifically the area between the 50% and 61.8% levels. To increase our probability, we look for confluence. This is the search for multiple technical signals that align at the exact same price zone. Look to the left of your chart. We are searching for old resistance lines or structural trend lines that intersect with our Fibonacci levels. Notice on this chart how the red 61.8% Fibonacci line perfectly aligns with the black ascending trend line. This intersection creates a high probability zone. When the price hits this point, it finds historical and mathematical support, leading to a sharp reversal. This works because different types of traders are all watching these same boundaries. When indicators overlap, a higher volume of buy orders is executed at that specific price. Waiting for confluence is what separates professional execution from simply guessing where a pullback might end. Even in a confluence zone, never set a blind buy order on a line. We must wait to see how the market reacts to the level. The final requirement before entering the trade is price action confirmation. In this example, the price drops to the 38.2% line and forms a bullish harami pattern. This candlestick signal confirms that buyers have taken control of the zone. Once that confirmation candle closes, the setup is complete and the trade can be entered. To manage risk, we immediately place a stop-loss order. The rule is to place the stop-loss just below the original swing low. If the price breaks this point, the trend structure is invalid. To set a profit target, we use Fibonacci extension levels. The 161.8 level shown here serves as a target for where the new wave is likely to peak. Combining mathematical zones with candlestick confirmation and defined risk parameters creates a complete executable trading plan. We apply this exact workflow to a downtrend. This 3-panel setup shows the process on the USD JPY. We map the downward impulse, wait for the 50% retracement, and enter as the bearish engulfing candle confirms the zone, capturing the drop. Open your own charts, find a clear trend, and plot your first retracement sequence. You have translated mathematical theory into a concrete system for identifying value in the market.